everyone, welcome to this week's MFB News. I hope everybody is doing very, very well and you haven't turned into freezy pops. My word, it has been cold, hasn't it? Now, in terms of what we've got for you this week, look, you know what, guys, I'm not going to kind of escape the kind of sense that we understand that actually things are going very much in the wrong direction. So we're going to talk about that in more detail. And by that, what I'm referring to is what's been happening in the bond market and the impact that's having on mortgage interest rates. So we're going to talk about that, and then we're going to move on to the latest amendments to the Renters' Rights Bill. It's Wednesday morning, very, very early. You can see it's pitch black out behind me. Voting on the amendments went through last night, so we're going to cover off some of the changes to the Renters' Rights Bill that are going to be passed through as the bill progresses. I'm sure the majority of you will have seen the headlines in the last week talking about the fact that the bond market has hit a 30-year high, which is true in part, although it doesn't necessarily paint the full picture about what's going on. But there is no escaping the fact that actually the bond market has had a very turbulent week. So before we kind of delve into what's been going on and why, I think it's just useful just to kind of quickly talk about the bond market and gilts and some terminology so we all understand what we're actually referring to here. So a gilt is actually a bond. They're not different things. A gilt is a type of bond, but a gilt is essentially a bond issued by the UK government, and it's considered a really, really low risk investment. If you're going to invest money and lock it away with the government for 30 years, you're going to want to make sure that actually the government isn't going to go bust, basically. So you're going to get your money back, and you're also going to see a return on your investment, so your interest rate as well. So these are essentially a way for the government to borrow money in exchange for an interest payment. The interest rate on gilts set prices for things like mortgages, financial derivatives, and can dictate government spending plans as well. They are essentially the foundations of the country's financial system, so fairly important. And the rise in gilt yields has impacted swap rates, meaning that the lender's cost of funds has increased. We all know about swap rates. I know I talk about them incessantly. So essentially, lender's cost of funds has increased, which means we're going to see an increase in mortgage pricing. Now, the other big question is going to be, why are gilt rates increasing? So lots of factors go into gilt rate pricing. Of course, these things are never kind of straightforward. But in short, to my mind, there are two key things going on here. So first of all, the US. The imminent arrival of their not-so-new President Trump, and also their debt positions. Their debt position has increased significantly, doubled, I think, in 10 years, actually. So the situation in the US is feeling quite precarious, and things ripple across the pond. The UK financial market is very kind of close to the US financial market, so things knock on. Secondly, our government are having to pay a high rate of interest on their gilts to attract investors, because we are now seen as a higher risk country than we were a year ago, even 3 months ago, and that can be in part at least linked to Rachel Reeves's autumn statement. So essentially, our credit rating has fallen, so we're having to pay a higher rate of interest to attract investors to save money with the government, invest money with the government. Higher interest rate paid out to investors means that actually that would impact swap rates, and therefore, as I mentioned earlier on, we're going to see the mortgage interest rates increase. So moving on to how this has impacted swap rates now. So as you would imagine, based on everything that I'm saying, we have seen further increases in swap rates. So as of last night, 2-year swaps were at 4.35. 1 month ago, they were at 4.09, and also actually incidentally 1 year ago, 4.09%. So we can see that things have month on month increased by circa 0.25%. 5-year swaps are now at 4.22, 1 month ago 3.86, and 1 year ago 3.5. So month on month we're kind of 0.4% higher, and 1 year on year rather 0.7% higher. So you kind of give you a flavour of how it's impacting things. So how is this landing in the real mortgage world? But what we're seeing, and we've particularly seen over the last couple of days, is an absolute wave of lenders having to pull their rates and reprice them upwards. So I don't want to kind of align this to the mini budget and the fallout of that, because what's going on here is nowhere near as severe, but actually you kind of get the sense of it. So on Monday we probably had about 14 lenders all withdraw their rates and reprice, and this was replicated on Tuesday, and actually we're expecting further repricing today. So what's the kind of takeaways for you guys? What can you do to protect yourself? So first of all, it's obviously very clear that we're in very, very sort of tumultuous waters right now. And as I've mentioned in previous episodes, one of the things that you can do is that you can apply for a mortgage on rates available today. You can lock your rate in. and know that if between the point of application and completion the lender drops their interest rates down, you can ask them to take one of their new lower rates. Now, some lenders simply do this for free. Some lenders will charge you a small application fee for doing this, sort of circa £150. And some lenders don't do it at all. The majority do. But if this is a kind of angle that you're thinking might be quite useful, and I would encourage you to really think about this being an angle that would be useful to you, then actually it's worth just asking the question. But really what this kind of does is hedge your position. So essentially what you're going to be doing is applying for an interest rate now, knowing that this is your kind of worst case scenario. And if interest rates do come down before completion, happy days, you can have that lower interest rate. But know that if interest rates do continue to increase, and there is a possibility of that, actually then your position is protected. In terms of how long we think this is going to carry on for and how bad it's going to get, I mean, it really is very hard to say. There's certainly talk that the capital markets, or the bond markets rather, are punishing racial arrears a little bit, and actually we might see things settle down a bit over the coming sort of weeks. But I think the reality is that the situation we're in right now is here for at least until the end of January, I'm afraid. I think this is the first time I'm ever going to be able to see the renters' rights bill as a small positive subject in the previous thing I was talking about. It is very doom and gloom, I know it is, and it's not what anybody wants to be hearing, and we are so frustrated, and the lenders are going to be so frustrated by the situation as well, and it is really worrying for people. Like I said, I do think this is a spike, and it's not going to last forever. But the reality is that that's the situation that we're in right now. So hopefully the explanation about what's going on at least gives you some context. I appreciate that doesn't make the prospect of higher mortgage rates yet again any easier to palate. So moving on to the Renters' Rights Bill. So amendments from the committee stage were voted on in the House of Commons before the bill completed its journey in the Commons on the 14th of January. So this was just yesterday. The bill now moves on to the upper house for further scrutiny. Disappointingly, the UK government has so far refused to reconsider the removal of fixed-term tenancies, despite challenges from the sector. So it's been confirmed that the bill will not contain any regulations for minimum EPC standards. That's going to be something which is consulted on separately by the Department for Energy, Security and Net Zero in the coming months. So we're going to go through each of the amendments in the bill one by one, just because there's quite a few and they're actually quite important. So first of all, we're going to start on limiting rent in advance. So essentially what the bill is saying is that actually you're going to be only able to take 1 month's rent in advance from tenants going forwards. Now, we know as landlords that if you have a tenant whose maybe situation isn't really ticking all of the boxes, but actually because they can give you 6 months or a year's rent up front, you're willing to kind of take a flyer on them, but be a bit more kind of risky in terms of letting them take your property on. Unfortunately, under the bill, that's going to be disappearing. So the report that I was reading last night was saying that people on fixed incomes like pensions, those with lower incomes, the self-employed and overseas students may all have challenges in passing referencing and affordability checks. Paying a large proportion of their rent at the start of the tenancy gives an alternative way to evidence their ability to sustain a tenancy, giving landlords confidence in renting to them. So this is not good news for those guys. Incidentally, Housing Minister Matthew Pennycock has stated that landlords will still have the ability to request 1 month's rent in advance, alongside a security deposit of 5 or 6 weeks rent. So that's kind of your safety net there. So sort of circa 2.5 months rent. He went on to say that the use of referencing and affordability checks and the ability to request guarantors should be enough to give landlords confidence. So there you go. So that's the first bit of news. The second item on the agenda was eviction grounds for student tenancies. So the bill currently only makes ground 4A, which allows landlords to regain possession of their properties between the months of June and September to allow them to relet for the next academic year, available for student HMOs if the tenancy is signed less than 6 months before its start date. Now, the issue here is that actually for those of you who work in the real student space, you're going to know that actually it's very commonplace for students to sign up their properties up to a year in advance. So unfortunately, if that was the case, you wouldn't be able to access the grounds for 4A. So what does this mean? So I think the reality is the downside here is that lots of landlords are going to be saying to students, I'm really sorry, I know you want to get organised for 12 months time, but actually I'm not prepared to sign this tenancy until we are 6 months away from the tenancy starting, because I need to be sure that I have access to the ground 4A to be able to run my business. Now, furthermore, this ground does not apply to 1 and 2 bedroom, so non-HMO properties rented to students. And this is all also leading to serious concern that the property owners will not have enough security to continue to offer their properties to students, thus removing student properties from the market, which will again, as we know, just push up student-let pricing. Okay, so next up, landlord fees to fund the ombudsman. So we know there's going to be a property ombudsman, and that's going to be funded by fees paid by landlords. And this is going to be directly fund the creation and work of the private rented sector ombudsman, providing renters and landlords with access to an effective dispute resolution service. I mean, we knew the ombudsman was coming in. I think we all knew that the landlord was going to end up paying for it, so this wouldn't come as a huge surprise. Interesting one next, guarantors cannot be liable after a tenant dies. So if you're standing guarantor for a tenant, your tenant passes away, you're no longer going to be liable for their rent. Housing Secretary Angela Rayner, my most favourite person in the whole world, commented that this will safeguard bereaved guarantors, who are often family members, against financial hardship during times of grief. I think we can all understand that one. Next, we move on to the private rental sector database, which is where the government is now setting out information that will need to be required about the landlord and the properties which they rent out. And this includes the name, address and contact details of the landlord, and also the managing agent, details of any enforcement action taken against the landlord or the agent, and details of any previous eviction notices that have been served to a tenant. So essentially, a bit of a quick bio on the landlord and what they have been up to. Registration is going to be compulsory, and the cost of the database will be covered by landlords. Home adaptations for disabled tenants is the final one. So although this amendment was withdrawn before the vote, Penny Cook did give assurances that it will be discussed further at the next stage. The proposal would give disabled tenants a right to appeal if landlords do not agree to adaptations recommended by a local authority home assessment, as long as the adaptations are reasonable adjustments under the Equalities Act 2010. So examples of reasonable adjustments include installing ramps or grab rails, changing taps and light switches, widening doorways, or installing motion activated lighting near to doorways and paths. So like I say, these are the latest amendments to go through. The bill is continuing on its journey. We'll continue to update you on that and discuss the impacts of it as we go. I have to be honest with you, given the kind of horror story that has been some of the things in the Renters' Rights Bill, why these changes aren't particularly great, I don't see them as anything really groundbreakingly terrible either. And so that's how we finished this week. I'm so sorry. I really want to come to you with a positive, excited episode telling you about how to, fund HMOs and stuff. But at the moment, the news is just so great on all this other stuff that's going on, which we simply cannot ignore. So fingers crossed next week will be a more positive episode. We have the inflation data. Actually, it was being read out as I started recording. So we'll talk about the inflation data and how that's impacted the market next week. Fingers crossed it's kind to us. But for now, I think it is just time really to kind of keep our heads down, keep warm, get through January. It certainly does feel that, particularly for those of you who are doing a dry one. And yeah, hopefully we'll hope for better news next week, which point I will see you. Take care of yourselves until then.